Hello everybody, today we're going to discuss forecasting balance sheet, income statement and cash flow statement. Let's get started. In the first part we'll cover some basic things. I will introduce you to main things about forms of financial statements. So as far as we know, there are three forms of financial statements: income statement, balance sheet and cash flow statement. All those financial statements are in fact interrelated, which means that, for instance, cash from cash flow flows directly to the balance sheet, and also some items from balance sheet, they can flow to income statement. And all those financial statements are interrelated. When you build a model, it could be the case that balance sheet is sometimes omitted, and instead only working capital is calculated. It's much easier for some models, for some companies, because you in fact are not required to forecast the whole balance sheet. Working capital usually suffices in this case. Also, there could be much easier models that use only cash flow projections. So you have just one cash flow statement and all other statements are omitted. But nevertheless, here we're going to discuss three financial statement models. And usually there are two different approaches to structuring a three-statement model: single worksheet and multi-worksheet. Single worksheet means that you build your model on one worksheet in Excel. And multi-worksheet means that you use a few worksheets in Excel. So what are the advantages of a single worksheet model? It's easier to navigate. There is no need to switch between tabs. There is less risk of mislinking formulas. All time periods are in the same column. Also, data is more organized with the use of grouping cells. This kind of modeling allows more room for consolidating multi-business companies because, for instance, you can use other worksheets, other tabs for different businesses. And now on this slide we see the main steps for forecasting a model, for building a model and for making some assumptions for the future. There are 9 steps here. Of course, they could be changed. It depends on the industry, it depends on the simplicity of the company, of the project, and so on. But nevertheless, we're going to cover all them here. And let's start with the first 3 steps. So first of all, of course, you need to input historical financial information into Excel. You need to take at least 2 years of the historical financial information, maybe even 3 years. And then you type or paste it into Excel. Data should be organized in columns, ascending from left to right. Then some basic formatting is used so that you can make the information easier to read and you make it follow the model structure. Then at the second step, you classify financial statements. So you usually take some financial statement items and you suit it your needs. It could be the case that, for instance, companies lump line items with different drivers together. Which means that line items need to be separated and forecasted separately. It could be vice versa, that certain line items could be broken out into current and long-term components, for instance. So it could be like long-term and short-term debt. However, for forecasting purposes, they can be combined because they have the same drivers. At the third step, we need to determine the assumptions and drivers, which means that, for instance, we need to forecast revenue drivers, we need to forecast margins, capital expenditures, working capital, and so on. This part was covered previously in our lectures, so we're going to move further. And here we see the other steps that are going to be covered at this lecture. So you need to forecast the income statement to the level of EBITDA at the step 4. Then capital expenditures are forecasted at the step 5. then you forecast financing activity of the company. After that, you can complete the income statement because you have got all the data that you needed for your income statement. So we have got EBITDA, then we have got depreciation from the step 5, and then we have got interest expenses from the step 6. So at the step 7, we complete the income statement. Then at the step 8, we can forecast the balance sheet. And at the step 9, we finish the model by forecasting the cash flow statement and completing the balance sheet. But now we move to the next part of our lecture, forecasting balance sheet. So if we consider the steps in forecasting, right now we're at the step 8, where we need to forecast the balance sheet. Here on the slide we have general information about items that we usually see on the balance sheet of any company. So if we have a look at assets, usually we have accounts receivable, inventory, fixed assets, other assets, and of course we have cash and cash equivalents. If we look at liabilities, here we can see accounts payable, debt, which includes both long-term and short-term debt. We usually have other liabilities, and that's it. At the equity level, we have shareholder capital and retained earnings. So let's try to understand better how those balance sheet items could be forecasted. If we talk about working capital, we usually mean accounts receivable, inventory, and accounts payable. And those items are forecasted in different ways. We have already covered this part in our previous lectures, so I'm going to be short with this question. The first way is that you simply use a percentage of revenue. So you calculate the total net working capital, which is accounts receivable plus inventory minus accounts payable, and you forecast this as a percentage of your future revenues. The second way would be more difficult and more different. You need to consider different components of your working capital. So you consider accounts receivable, inventory, and accounts payable, and you forecast them separately. Also, of course, we need to forecast other assets and other liabilities, and it's not a clear question how you can do it the right way. Because, for instance, if we look at financial statements of companies, those statements are not well presented there. You cannot understand clearly what they include sometimes, and it's a question always how you should do it. There are different ways that are used by analysts. The first way would be that you simply fix your other assets and other liabilities at the level of the last period, and you prolong it for the coming years. It's not so rational. That's why other variants are used. For instance, growth rates. Usually other assets and liabilities tend to grow with revenue, which means that you could inflate them using the growth rate of your revenue. And another way would be using different drivers. So when you understand clearly what other assets and other liabilities include, you can split them into different factors, into different parts, and understanding drivers behind them, you are able to forecast how they're going to grow or decline in the future. And now let's consider how cash flows are forecasted. If we look again at the steps that we have already covered, right now we're at the step 9, where we need to forecast the cash flow statement and complete the balance sheet. Usually, there are two possible ways to forecast cash flow statement: direct method, which is in fact rarely used, and indirect method. Let's discuss them in detail. So if you consider a direct method, usually assume direct cash flows and cash outflows of your business. But to do that correctly, you need to understand your business really well. You need to be able to forecast all your cash flows correctly. And it cannot be done really easily. That's why analysts usually prefer to use indirect method. And let's go through this method and understand why it could be used and how it's calculated. Here we see a typical cash flow of a company presented in a way of indirect method. We start from net income, then we add some non-cash charges, including depreciation. We correct this by changes in working capital, and we come to the level of cash flow from operations. Then we calculate cash flow from investments, and then we calculate cash flow from financing. So again, let's understand better how it could be done. So when we forecast cash flow from operations, we start from net income, which flows from the income statement. So it becomes the top line of the cash flow statement. Then we adjust non-cash items on the income statement, which includes again depreciation, and also it could include other factors like foreign exchange differences and so on. Then at the next step, we project cash flow from investments and cash flow from financing, which are again based on the methods that we have already covered in our previous lectures. After that, we calculate the net change in cash at the bottom of the cash flow statement. Sometimes it's required to build a revolving credit line to avoid cash gaps in the model. It could be the case that you have forecasted cash flow from financing, for instance, but nevertheless, your cash balance at the end of some periods is negative, which means that you need to use some additional financing to avoid this error in your model. Revolving credit lines are used in this case. After you have created a revolving credit line, you get the final cash on your cash flow statement, and this cash flows into the cash on the balance sheet. And now let's wrap up what we have just covered and understand how financial statements are linked and what's important when building a 3 financial statement model. Here again the steps that we have gone through, and now we need to understand better main principles that should be taken into account when preparing a financial model. Principle number 1. Each item on the balance sheet must have a corresponding item line on the cash flow statement and vice versa, which means that, for instance, the change in each item on the balance sheet must be reflected once and only once on the cash flow statement. When an asset goes up, cash flow goes down, and when a liability goes up, cash flow goes up, and vice versa. This means that, for instance, if you raise a debt, then of course it's going to have an influence on your balance sheet, and your debt on the balance sheet is going to grow. The same effect we're going to see on the cash flow statements. So we will see that debt is going to be raised in the cash flow from financing activity of the company. Principle number 2. The cash flow from operations section of the cash flow statement is derived from the income statement and operational items on the balance sheet. And the cash flow from investments and cash flow from financing sections are projected using supporting schedules and then flow into the balance sheet. That's what we have already covered in our previous lectures. Let's move further. Principle number 3. When linking items from the cash flow statement to the balance sheet, subtract when you are on the asset side and add when you are on the liabilities and equity side. For example, if we look at property, plant and equipment, we need to subtract both depreciation and capital expenditures due to science. When we look at debt, we add both issuances and repayments due to science. And the final principle is that your balance should balance, which means that at the end, you need to have reasonable information, reasonable financial statements, forecasts, and your data should be also rational. If your assets are not equal to your liabilities, there is a mistake in your model. It's not the only check that we can make in the model. Of course, your model needs to be reasonable, which is usually called sanity check. You, for instance, could look at different margins, at how your debt level fluctuates from time to time, whether your forecast looks reasonable from the point of view of external users. And here, at this picture, we see the whole structure, how financial statements forecasting works properly. We have three financial statements: income statement, balance sheet, and cash flow statement. And we have three main supporting schedules for them: working capital schedule, capex depreciation schedule, and equity debt schedule. Putting everything together, we can get clear results and clear forecasts for the model. Hello everybody, today we're going to talk about taxation in models. And to understand this question better, let's consider different tax regimes and different kinds of taxes that we can see in financial models. So first of all, tax regimes. Usually there are two kinds of tax regimes: general tax regime and special tax regimes. Let's have a look at them and understand better how they're different and why. When we talk about special tax regimes in Russia, for instance, we can see two main kinds of such tax regimes: simplified tax system and unified agricultural tax. If we talk about simplified tax system, the tax rates for the companies that use this tax system are usually lower compared to the general tax system. It could be either 6% of sales or 15% of the company's profit. Taxable period is a calendar year, and the tax base is, as we have just discussed, depends on the mechanism that the company has chosen. It could be either sales or income of the company. Then tax calculation is pretty simple. You need to multiply the percentage of the tax by the tax base, and this way you get the final tax that you need to pay. Also, the annual tax return must be filed to tax authorities once a year. By legal entities, it should be done not later than the 31st March, following the expired tax period. Then in Russia we have also another special tax regime, which is called Unified Agricultural Tax. This tax regime can be used by agricultural companies, which we can see from the name of this tax regime. Tax base for this tax regime is sales minus costs, so in fact it's the company's profit. The taxable period is calendar year, 1 calendar year, then reporting period is half a year, and the tax rate is 6%. In fact, the tax rate can be even lower because it depends on special regulations for different regions. The region can choose that the companies using the unified agricultural tax are not obliged to pay any tax at all. So the tax rate can be even zero, as we pretty often see here in Russia for agricultural companies. So tax calculation is also pretty simple. You multiply tax rate as a percentage by the tax rate, and this way you get the result. The advance payments are made not later than on the 25th day of the first month following the expired reporting period, and then the final tax is paid not later than on the 31st day of March of the year following the expired tax period. Also, in Russia, we have other taxes that we pretty often see in financial models. These taxes are also pretty the same for companies from the whole world. So we can see them for the companies in the USA, in other countries. Value-added tax, that in the USA, this tax is similar to sales tax. We'll discuss it a bit later in detail. Then the companies need to pay corporate tax, which is called sometimes profit or income tax. Then we have property tax, payroll tax, dividend tax. It's worth mentioning that dividend tax is in fact a part of corporate tax. It's just a special case of it. But nevertheless, I decided to cover it a bit in detail here because this question arises pretty often when you build a financial model. Excise tax and mineral tax. Of course, it's not the whole list of potential taxes that that we can see when we build a financial model, but it's the taxes that we see most of the time. But now let's consider value-added tax and how it can be projected in financial modeling. So first of all, let's understand what value-added tax means. A value-added tax is collected on a product at every stage of its production during which value is added to it, from its initial production to the point of sale. The amount of value-added tax that the user pays is based on the cost of the product, less any costs of materials used in the product that have already been taxed at the previous stage. A value-added tax is levied on the gross margin at each point in the process of manufacturing, distributing, and selling an item. The tax is assessed and collected at each stage. That's different from a sales tax system, which we can see, for instance, in the USA. In this system, the tax is assessed and paid only by the consumer at the very end of the supply chain. More than 160 countries use a value-added tax system, and it's most commonly found, for instance, in the European Union. The United States, as we have just discussed, remains the only notable exception in this case. If we compare, for instance, value-added tax system and sales tax, we can see the following main differences here. So value-added tax is paid at different stops along the supply chain, whereas the sales tax, for the sales tax, the entire amount is rendered after the sale. In the case of value-added tax, it's easy to track the tax itself. The exact tax levied at each step of production is known. In case of sales tax, it's really difficult to allocate this tax to specific production stages, because it's paid only at the end of the chain. So, for instance, in Russia, we have the following basic terms concerning the value-added tax. Taxpayers are legal entities and individual entrepreneurs. Subject to tax are sales of goods, works and services, transfer of property rights. Taxable period is a quarter of a year, and tax rates could be different from 0 to 20%, depending on the type of goods and operations. In some cases, a calculation rate is applied, for instance, upon receipt of advance payment. The tax calculation is pretty easy. It's percentage share of the tax base. The tax is paid for the expired tax period in equal shares, no later than on the 20th day of each of the 3 months following the expired tax period. And tax return is not later than on the 20th day of the month following the expired quarter of a year. So if you want to calculate value-added tax, you can use the following formula, which is the same for Russia and for other countries that which use this tax system, value-added tax. Value-added tax to be paid is equal output value-added tax minus input value-added tax, where output value-added tax is a tax charged on the sale of goods or services. It's charged on the selling price of those goods or services. Input value-added tax is the tax which is paid on the purchase of goods or services. It's paid at the cost price of those goods or services. So this way you can calculate the value-added tax that you should pay in the specific period of time. There are different methods how you can treat value-added tax in financial models. The direct method, for instance, if you have the direct method for cash flow statements, then you need to forecast value-added tax precisely and include it into your model. So value-added tax should be projected in this case anyway. If you use indirect method for cash flow statements, which is pretty often the case in financial models, then there could be different ways how you need to deal with value-added tax. So here are recommendations that are pretty often used by analysts projecting a financial model. If your company or project has a big investment program, then value-added tax should be projected at least for cash flow from investments. In this case, you need to understand that you can refund a part of your capital expenditures and get value-added tax refunded from the government. That's why it should be projected in the best case. Then, in other case, your company can have negative gross profits, which means that you don't pay value-added tax. You don't have to pay it, in fact, because your sales, they are less than cost of goods sold, which means that you pay more value-added tax than you get from your customers. In this case, you can even get a refund of value-added tax from the government, from tax authorities, and to forecast value-added tax cash flows for your model precisely, of course, you need to project it for your cash flow from operations at least. Then, another scenario that we could have is that the company has a negative gross profit and also it has large investment program. So in this case, I would recommend that you project value-added tax both for cash flow from investments and for cash flow from operations. So your model should include value-added tax for all cash flows that you use in your model. As we have just covered a bit, there are cases when a company can get a value-added tax refund when it happens. So if output value added tax is more than input value added tax, the company is able to refund the value added tax paid. It's often the case, for instance, with a large investment program, as we have just discussed. The company pays more value added tax than it gets from its customers. which means that the company gets a right to get the value-added tax refund from tax authorities. There are a few things that I wanted to mention today concerning value-added tax and its treatment on the balance sheet. Accounts receivable on the balance sheet include value-added tax. Also, accounts payable on the balance sheet include value-added tax. But in case of inventories on the balance sheet, value-added tax is not a part of inventories, because in this case, value-added tax is allocated to a special account on the balance sheet, value-added tax receivable. Let's consider accounts receivable forecasting and how it's related with value-added tax. We remember this formula from our previous lecture. So to forecast accounts receivable, you need to divide accounts receivable days by 365 multiplied by sales. And to calculate accounts receivable days, you need to divide accounts receivable by sales and then multiply by 365. But at the same time, we can see that accounts receivable include value-added tax, whereas sales don't. In case of accounts payable and value-added tax, we have, in fact, a similar situation. So to forecast accounts payable, you divide accounts payable days by 365 and multiply it by cost of goods sold, where accounts payable days is equal to accounts payable divided by cost of goods sold multiplied by 365. So at the same time, accounts payable include value-added tax, whereas cost of goods sold doesn't include. In case of inventory, we have a different situation. To forecast inventory, we multiply inventory days by cost of goods sold and divide by 365, where inventory days is equal to inventory divided by cost of goods sold and multiplied by 365. Both inventory and cost of goods sold don't include value-added tax. Corporate tax rate. A corporate tax is a tax on the profits of a corporation, also known as profit tax. The tax is paid on a company's taxable income, and corporate tax rates, they vary widely by country. In Russia, it's for instance 20%. Corporate taxes can be lowered by various deductions, government subsidies, and tax loopholes. And so the effective corporate tax rate, the rate of a corporation, is usually lower than the statutory rate. Let's consider corporate tax rate on basis of Russian Federation. In Russia, corporate tax rate is called profit tax. Taxpayers are Russian businesses, non-Russian businesses that operate in the Russian Federation through permanent establishments or gaining income from sources located in the Russian Federation. Taxable object is profit, tax base is also profit, reporting period first, second and third quarters of the year, tax period is calendar year, and tax rates 20% general rate unless otherwise specified by the law. Advanced payments are made for each reporting period, as a rule on a monthly basis. The taxpayer may also opt for reporting taxable income and making payments on the basis of its actual results on a monthly basis. Tax return filing, return at the reporting period end must be submitted to tax authority not later than 28 calendar days from the relevant reporting period end. Annual tax return must be submitted to tax authority not later than on the 28th day of March or the year following the expired tax period. And now let's understand better how taxes can affect balance sheet. There are two things that I wanted to cover on this slide: deferred tax liability and deferred tax asset. Deferred tax liability or asset is created when there are temporary differences between book tax and actual income tax. There are numerous types of transactions that can create temporary differences between pre-tax book income and taxable income, thus created deferred tax assets or liabilities. It could be, for instance, that the company uses different accounting policies for bookkeeping and for calculating profit taxes, which leads to differences in amortization and depreciation costs for tax reasons and for bookkeeping. Understanding changes in deferred tax assets and deferred tax liabilities rather than the net value of the two allows for the improved forecasting of cash flows of the company. And now let's better understand what leads to deferred tax liabilities and deferred tax assets and why they arise in general. So, first of all, it could be the difference in the timing of revenue and expense recognition principle in the income statement and tax return. As we have discussed before, it could be, for instance, different depreciation policies for the income statement and tax return. Then, it could be specific revenue and expenses that are recognized in the income statement but never on the tax return or vice versa. Assets and liabilities can also have different carrying amounts, net value of assets or liabilities on the balance sheet, and they can have different tax bases, which again leads to this discrepancy. Then, gain or loss recognition in the income statement can be different from the tax return. Tax losses from the prior period may offset future taxable income, which is often the case when a company is growing pretty fast and it had many losses last years, and then the periods when a company starts earning some profits, it's still may pay no taxes because of losses that it had before. Then financial statement adjustments may not affect the tax return or may be recognized in different periods. And here, the income tax expense equation that equates tax expenses recognized in the income statement and taxes payable to the tax authorities and changes in deferred tax assets and liabilities. Income tax expense is equal to taxes payable plus deferred tax liabilities minus deferred tax assets. And what we should know about forecasting corporate tax rate. First of all, you need to understand the concept of the effective tax rate. The effective tax rate can be defined as an average rate of tax payable by an organization or a person. Here we're talking about a company, of course. The average rate at which an individual's earned or unearned income is taxed is known as the effective tax rate. For corporations, the effective tax rate can be found by dividing the tax expense by the earnings before tax of the company. Usually, simply straightlining the last historical year's tax rate is sufficient. However, there are times where tax rates historically are not indicative of what a company can reasonably expect to face in the future. If a company's profit is negative, the company doesn't pay a corporate tax in the corresponding period. Companies may use losses of last years for decreasing the current year's profits. That's the concept that we have already discussed a bit. A net operating loss or tax loss carry forward is a tax provision that allows firms to carry forward losses from prior years to offset future profits and therefore lower future income taxes. The way a tax loss carry forward works is that a schedule is generated to track all cumulative losses, which are then applied in future years to reduce profits until the balance in the tax loss carry forward is zero. And what are the methods how we can forecast corporate taxes in financial models? The first method, I've called him detailed approach. And to forecast corporate taxes using this method, you need to use statutory tax rates, take into account all the factors that could influence the effective tax rate of the company, and forecast taxes payable. Then you need to get a deep understanding of deferred tax liabilities and deferred tax assets, and project them on basis of their components. And the second method, which is pretty often used in equity research, for instance, where you need to build a model really fast and you don't need so many details, is a so-called simplified approach. So you use the effective tax rate based on the average effective tax rate for last periods, and then concerning deferred tax assets and deferred tax liabilities, you can use any of the methods that I have listed here. The first method is that you include deferred tax assets and deferred tax liabilities in accounts receivable and accounts payable respectively, and forecast them for future periods. Then another way is that you add deferred tax liabilities to equity and subtract deferred tax assets from equity and forecast balance sheet without those items on the balance sheet. Then another simplified approach is that you fix deferred tax liabilities and deferred tax assets on the balance sheet at the current level, or you can simply link them to their drivers, which could be revenue, costs, etc., depending on the nature of those assets and liabilities. And now let's consider other taxes that can be seen in financial models and understand them a bit better. So first of all, property tax. Property tax is a tax paid on property owned by an individual or other legal entity such as a corporation. Most commonly, property tax is real estate ad valorem tax. It's calculated by a local government where the property is located and paid by the owner of the property. The tax is usually based on the value of the owned property, including land. However, many jurisdictions also tax tangible personal property, such as cars and boats. And now let's understand better how corporate property tax is working in Russia, for instance. So taxpayers are businesses in possession of property objects which are identified as taxable objects. Taxable objects include immovable and movable assets recorded in the balance sheet as fixed assets. Tax base is annual average value of property. And taxable period is 1 calendar year. Reporting period, first quarter, half year, 9 months of a calendar year. And then tax rate is usually established by laws of the subjects. Regions of the Russian Federation and can't exceed 2.2% of taxable value. Tax is calculated as tax base multiplied by tax rate, which is estimated for the reporting periods and tax period. Tax payments is established by laws of the subjects of the Russian Federation, and advanced payments are paid at the end of the reporting period. Filing of the tax return is completed in the end of the tax period. And here we see how, for instance, real estate tax, property tax can be calculated on basis of the tax code of the Russian Federation. It's important to note that the basis for tax calculation is the company's financial accounts, not tax accounts. So you need to take book value of the current period, then add book value of the previous period. Here we're talking about quarters. Then you get an average of this. So you divide it by 2 and multiply by the tax rate. That's how you can calculate real estate tax rates in case of a company in Russia, for instance. The same way you can project it in financial models. You need to understand how property tax is working in a specific country where the company is present, and then you need to follow the rules of taxation that are specific for the country. And now let's understand a bit better how payroll tax works and how we can project it in financial models. So there are two different types of payroll tax. Let's say, in case of personal income tax, the company serves as a tax agent, and also companies are obliged to pay additional taxes, make additional assignments to budget when they have some personnel. And there are three methods that I could recommend when building a model. The first one is the detailed method. You forecast salaries of each employee and calculate payroll taxes directly. So you need to make a schedule with the whole list of employees the company has, and then you need to forecast it in the future. And on basis of this list and their salaries, you forecast potential payroll taxes and other payments to the budget in the model. So it's really the detailed method. The second method is that you calculate the effective tax rate for payroll taxes and other payments to the budget and use it in your projections. And the third method is the following. Payroll tax is projected together with payroll expenses as one line expense. For instance, it could be a percentage of revenue. Now let's move further. Dividend tax. A dividend tax is a tax imposed by a jurisdiction on dividends paid by a corporation to its shareholders. In fact, it's a part of corporate tax rate system. So dividend tax rate could be different depending on the type of stockholders, legal entities, people. Tax residency plays a role, of course. And for forecasting dividend taxes, I could recommend the following. First of all, you need to check tax legislation and understand the applicable dividend tax rate in your case. If the answer is unclear, then double check please with the tax advisor. If dividend taxes or some other tax questions could significantly influence your financial model and the result is pretty sensitive to taxes, then of course getting an advice from a tax advisor is recommended. Excise tax. So what is it? Excise tax is the tax applied to the sale of particular goods and services like tobacco, fuel and alcohol. It's not directly paid by an individual consumer. Instead, the tax department levies the tax on producer or merchant of products, and then they pass it on to the final beneficiary of products by adding it in the product price. The producer of a product has to pay this tax first, then only they can sell it in the market. So in simple words, if any excisable goods manufactured or produced within the country, then excise tax is applicable. There are two different types of excise tax. Ad valorem tax, fixed percentage. This type of taxes are charged as a percentage of the value of the goods or services produced by the company. It's nothing but the percentrum applied to the value of the product. And then a specific excise tax. This type of taxes are charged based on physical unit sold, for instance, weight, volume, quantity, etc. Examples include, for instance, liters, tons, kilos, gallons, and so on. Here we see the formula which can be used depending on the type of excise tax that we're facing. In case of ad valorem tax, fixed percentage, you simply multiply price of product by tax rate and then by quantity. This way you get the tax liability. If we are talking about specific tax, fixed currency, then you multiply quantity by tax per unit and get the final tax liability that you have to pay. And here I have listed main details concerning excise tax in Russia. Taxpayers include legal entities, individual entrepreneurs, and individuals who carry goods across the Russian Federation national boundaries. Tax base is sales of excisable goods. Yes, it could be spirits, alcoholic beverages, tobacco products, and so on. Taxable period is 1 calendar month. Tax rate is separately established for each excisable good. To get the tax amount that you need to pay, a multiple of tax rate and tax base percentage of the tax base corresponding to the tax rate is used for excisable goods which are taxed at ad valorem tax rates. Advance payments are done by alcoholic goods manufacturers, for instance. Tax payment should be completed not later than on the 25th day of the month following the reporting period for legal entities and possession of certificates, and then not later than on the 25th day of the third month following the expired tax period. Mineral tax. This tax is not so often seen, of course, in financial models. We can face this tax when we deal with oil refinery, with oil production, and all other companies that extract minerals from the ground. A mineral tax is any tax, excise, or other government-imposed fee on mineral resources, such as crude oil or ores. The taxation of minerals serves as a price to extract scarce resources such as petroleum and crude oil, which are owned by the government. By taxing minerals, the government is able to secure a certain share of the minerals. Here I have listed main points concerning minerals extraction tax in Russia. Taxpayers include organizations and individual entrepreneurs recognized as users of subsoil. Extracted commercial minerals are subject to tax. Tax base is the result of self-assessment tax. It's established at the value of extracted minerals or as a multiple of the quantity of extracted minerals and a certain solid tax rate subject to a coefficient. Taxable period is 1 calendar month. Tax rate is determined for each type of extracted mineral. Tax payment is completed not later than the 25th day of the month following the expired tax period, and tax return shall be filed not later than the last day of the month following the expired tax period. That's it, what I wanted to share with you today. Thank you for your attention. And now we're going to continue dealing with taxation in financial models, and in this lecture we'll consider detailed calculations of main taxes that are used in financial models. And let's get started with property tax. We assume that our company is located in Russia and it's living according to Russian tax regimes. We consider that the company uses the general tax regime. That's why the company pays 2.2% of property tax. And let's consider how it's calculated here. So tax base for property tax in Russia is based on average value of fixed assets of the company on the balance sheet. So here, for instance, when we look at the fourth quarter of 2018, we have a look at the average value of fixed assets of the company. So we take the value of fixed assets at at the end of the third quarter. Then we add the value of fixed assets at the end of 2018. We sum them up and divide it by 2. This way we have calculated tax base here. Then to get the property tax, we multiply our tax base by 2.2%, which is property tax rate, and we divide it by 4 because the tax is paid quarterly, so we simply assume that we're going to pay it every quarter and not just once at the end of the year. So that's easy, in fact. Now let's move to another tax that we can see in financial models pretty often. Profit tax. I would say that that's one of the main taxes in financial models because it directly influences your cash flows. So here what we have done, we have calculated tax base of the company. We have sales, we have then different kinds of expenses, and this way we can calculate the potential profit or loss of the company. So it will be our tax base here. As we see, this company starts getting sales only in 2019. That's why the company has losses during many quarters. And the result is that we can use tax loss carry forward. That's the losses that the company got in last periods. They can be used they can be used the way that the company is not obliged to pay any profit taxes in the coming periods. So let's have a look and understand how it can be done. First of all, we need a supporting schedule. Here we calculate it. So we add a row called new losses, and we put here figures of losses that the company gets. So if here we have 21 million losses in the fourth quarter of 2018, and then again we have losses, so on, and we calculate the balance of losses recognized in tax accounting. So we simply accumulate all of them. Here, for instance, by the end of 2019, we have already 157 million rubles in losses that we had in the past. This means that we can still use those losses to decrease our profit tax to be paid in the future. And as we see, until the fourth quarter of 2020, the company still has losses. Until, and only by the end of 2020, the company has got the first profit, which is equal to 96 million rubles. And then what we can do, we simply use our losses that the company had in the past, and we recognize them in the income statement. So as we see, the company earned 96 million in profits, which means that we can use the same amount of losses in the past, which allows us to pay no tax at all. So we have used a part of our losses that we had in the past. And this way we can do until tax loss carry forward is not equal to 0, which in fact happens by the start of 2022. And here, as we see, we have run out of any tax loss carry forward, which means that we cannot almost use it at all. We use the last amount of it, which is equal to 27 million rubles. But still, as our tax base is higher than our balance of tax loss carry forward, we have some taxes to be paid. So our taxable profit is going to be equal to 37 minus 27, which is about 10 million rubles. Then to calculate profit tax to be paid, we multiply taxable profit by the tax rate, which is equal to 20% in Russia. And so this way we can calculate profit tax to be paid. And in the next years, in the next quarters, there is no tax loss carry forward that can be used, which means that we pay the whole amount of tax that should be paid according to our tax base. So here we have earned 36 billion rubles of profit before tax, and it means that we need to pay 20% of this amount, which is 7.2 million rubles. So that's it, what you should know in detail about profit tax. Let's move further, and here we have another tax, salary taxes. So again, where in Russia, we assume that the company is operating in Russia. For salaries in Russia, we have personal income tax, where the company is an agent that pays it, but this tax is not going to be considered here in the model. We assume that it's paid directly from the employees' salaries. Here, what I want to point out is additional tax, which is in fact insurance payments. In Russia, any company is obliged to pay about 30% of the employee's salary to special funds, insurance funds, and here I'm just going to show you how it can be easily calculated. So we have salary payments, and to calculate a salary insurance payment to be paid, we multiply salaries by the rates, by this insurance tax rate, which is equal to 30%, and this way we get the amount of salary insurance payments to be paid. So it's easy. Now let's move to another pretty important tax in models, value-added tax. And let's understand how it can be calculated in financial models. So first of all, what I wanted to say is that there are two kinds of value-added tax for companies. There is the first one is value-added tax paid, which is also called input VAT, as we see here, and also another is value-added tax received, which is usually called output value-added tax. When does a company pay value-added tax? It could be capital expenditures, as we see here. Then it can be operational expenditures or maybe other expenditures that include value-added tax in it. And here what we do, we simply calculate the value-added tax which was paid by the company. Mostly, as we see, it comes from capital expenditures in the first years, because of course the company has a big investment program and a lot of money is invested in new fixed assets. So as we see in the fourth quarter of 2018, the company has paid 4.3 million rubles of value-added tax, but still the company has not got any revenue, which means that there is no value-added tax received or output VAT, which means that, again, like with profit tax, we still can use this value-added tax balance as a way to decrease our potential value-added tax to be paid in the future. What we do, in a similar way, like with profit tax, we calculate value-added tax balance. Now, as we see, we have overpaid value-added tax by 4.3 million rubles. And for the next years, we calculate another this value-added tax balance. As we see, until the third quarter of 2020, the company is still paying more value-added tax than it's getting from revenue. And only starting from the fourth quarter of 2020, the company can use value-added tax balance to be able to pay no value-added tax to the budget. As we see now, until the value-added tax balance is not equal zero, the company doesn't have to pay any value-added tax to the budget, because it's still the accumulated amount of value-added tax paid to other companies. It's still more than the company has got, which means that only as we see, only in the fourth quarter of 2022, the company will have to pay value-added tax to the budget. And now, as we see, there is nothing left from our value-added tax balance. The company has no accumulated amount that tax authorities owe to the company, which means that all value-added tax that we get here, so we can simply calculate value-added tax paid minus value-added tax received, and this will be the amount that we should pay to the budget. So thank you. In fact, that was it, what I wanted to share with you today about taxation in financial models. Please have a look at the model to get a better understanding of how taxes are calculated in financial models. Thank you for your attention.